2023. Let's get more. For that, we're joined by Raymond James analyst David Long. David, good to have you this morning. First, your reaction to this news itself. As our viewers can see, the stock, after reacting negatively a bit, is actually in positive territory.
Sure. Thanks, David. Thanks for having me on the show this morning. So a little bit of a surprise, the magnitude of the charge to the CFPB of $3.7 billion. But I will say is not a complete shock. The stock had underperformed month to date on rumors that there was a large fine and resolution coming. 3.7 billion, obviously pretty large. But the company does have a reserve against this within their financial statements, within their balance sheet. They upped that reserve up to 3.7 billion from 3.2 billion. Now, not all of that I think will be used for this, but it's something that I think the management team knew was potentially coming. But, you know, for the stock, as I said, this was something that was not a complete shock to us this morning, anticipated with the underperformance month to date. And I think this does work as kind of a clearing event. The uncertainty as to what the fine is going to be is now out there, and now we know what it is.
Yeah, I mean, I guess that was my next question. Is this the clearing event that many have been hoping for so you can simply focus on the fundamentals at Wells Fargo?
Sure. So when you look at the fundamentals of Wells Fargo, they are growing loans. They have a relatively good net interest margin relative to their peers. They've got good credit quality given the diverse loan portfolio. They're doing a lot of things right fundamentally. The other side of it is the ESG and specifically the governance. And that's something that's been a work in progress and has really accelerated since Charlie Scharf took over. They still have a long way to go. This is a very positive to get this fine out of the way. But there are still 8 consent orders out there, 2 of them with the CFPB. As those do come off, that does allow the bank to continue to improve their operating efficiency because they are spending a lot of money investing in improving their internal controls to work past these issues.
So it sounds like, David, that you are still bullish on this name going into 2023. Is that correct? And I guess in light of that, what do you think of the financials more broadly right now?
Yes, absolutely. It is a stock that we like into 2023. And by the end of 23, I think some of the larger banks will start to outperform some of the small to mid-sized banks. In the immediate near term, I'll tell you, going into January earnings, the focus is still on deposit betas and how much banks are going to have to pay to keep their deposits with their bank, and essentially what they're going to have to pay for those deposits. In the first half of 23, what we're looking for is the investor focus to move more towards the liability-sensitive names, those names that will put up some better net interest income when the Fed stops raising rates, and then also credit. There's concerns out there about the consumer. There's concerns out there about commercial real estate. So I think investors will have a bigger focus on those two things, the liability sensitive and credit in the first half of 23. Eventually, I do think there will be a recovery, but I think we're at least 6 months to 9 months away from that for the banks.
Yeah, I mean, just to dig into that a little bit more, I mean, we've seen this broader market sentiment shift from inflation to recession fears and slowing economic growth and what that's going to look like in the next calendar year. Financials and banks specifically have been pretty beaten up in recent weeks in light of that. Is it overdone, or do you think that makes sense right now and thus is providing opportunities to buy some of these names in light of that?
Sure. No, I think the investors are not broadly buying the banks here or increasing positions because of the shape of the yield curve, which is inverted. The risk that earnings estimates are too high, and I do think earnings estimates probably have to come down for the banks, broadly speaking. And then also a potential credit event where there could be some losses that come through. So those are the fears that are out there that we need to work through. After January and April, if we get a couple negative revisions to earnings estimates, I think you'll start to see the investors come back to the banks a little bit more broadly. But I do think in the immediate near term, there are some franchises out there that are valuable. As much as we're more neutral overall in the banks, I definitely think there's opportunities where you can make money on some of the stocks that have sold off more so than others, or that their overall long-term valuations are not appropriate just because of a near-term headwind. And I'd put Wells Fargo in that bucket, name a couple others, a First Republic, a Silicon Valley Bank, a couple other quality franchises that I think are undervalued here.
Okay. David, thanks for your time. Appreciate it.